we're going to get into the burning question on a lot of families and households' minds and investors' minds in general, the new rules of investing. How do you prepare for your family's future? We know so much has changed in just the last year, in just the last few years, but this last 10 months has been pretty incredible. So what do? I grab some of the smartest people I know. I bring them on stage with me. Let's bring them to the stage. Now, Carolyn McClanahan, I called an audible here. She's in the house, so I'm going to have her join the panel. Liz Young, the head of investment strategy at SoFi, is here, and our good friend Kristin Myers, the editor-in-chief at thebalance.com. Thank you so much. You too. Put you on the other end. Thank you. Thanks so much for being here, guys. I appreciate it.
Yeah.
Always good to be surrounded by people, some of the smartest people in the business. So we know a lot has changed. We're in a pretty dire little bear market here. It's pretty aggressive. It's one of the worst starts to a year, even though we're 9-10 months into it. I think in the history of the S&P 500, the second or third worst. The 60-40 portfolio, the worst year ever. Usually when stocks are down, bonds help you out a little bit. Not the case this year. A lot of dynamics are changing in our capital markets, but a lot has changed in terms of the way we invest, a lot of the way we think about investing, the tools, but also the principles. So some of the ground rules are always the same, but some of the practices are different, and that's really changed the landscape for investors. Kristin, if you would, since you're so close to it, and you get all those great questions from your readers at The Balance, such good content there, set the stage for us in terms of where we are as investors, as households in the United States today.
Yeah, so I was looking just at like household wealth recently, just especially as we've been in this bear market. So everyone's investment accounts are probably down 20, maybe even more percentage points. And so we actually saw a loss of $6 trillion actually in household wealth. Now, when it comes to wealth in the United States, I think everyone pretty much knows that most of it is held in the top 10%. So the total amount of wealth is about 136 trillion. The top 10% has over half that, actually. But what I did find most interesting is that while infinitesimally small compared to the total number, for the bottom 50% of all Americans, we've actually seen their wealth double over the last 2 years. And I think this is in part because of what happened throughout the pandemic. People are staying home. They're watching a lot more financial news. They're trying to figure out, what should I be doing with all this extra cash that I now have? Because I'm not going out, I'm not doing anything. And they started putting it in the markets. And it was a great time to put your money into the markets. What they continue to do after this, I think, still remains to be a huge question, because for a lot of those new accounts, this is going to be their first bear market test that they're going through, particularly millennials who have just seen the markets go from strength to strength to strength. But yeah, we've seen essentially that wealth completely double. We've started to see more and more folks investing, younger investors, and I think a much greater appetite for financial information than we really ever have before.
Yeah, absolutely. But welcome to the stock market. Oh, this is a bear market, by the way. After 12 years, pretty much everything is working right now. So Liz, you follow this stuff very closely. I know we could go super deep on this. Let's try to keep it where we can all grasp it. The dynamics have changed, right? We went from a Federal Reserve that had floored interest rates to basically zero for years, and maybe they popped them up a little bit, and actually buying government bonds and government-backed mortgages, to doing the exact opposite. How has that flipped everything on its head?
Yeah, so hi everybody, first of all. Let's put some numbers around what this year has looked like so far. The S&P 500 is down about 22% year to date. You mentioned a stat before. If we go back to 1928, this is on track to be the 7th worst year ever. The other 6 are only during the Great Depression, the global financial crisis, and the dot-com bust. So not a great setup where we are right now. And then if you think about bonds, so we look at it based on basically high quality bonds, which are investment grade bonds and treasury bonds. Investment grade is down 20% this year. Treasuries are down 14%. That is 3 to 4 times worse than the worst year previously. So it's been a tough year. And if you are feeling frustrated as an investor, you are not alone. I can promise you that. This is, and I mean this sincerely, this is the hardest year I've ever had as a strategist to try to make calls on what the market is going to do. And it has been probably the most humbling year for many, many investors. So if you are frustrated, again, you're not alone. What's changed in large part is the landscape around, obviously, inflation. I don't think anybody in here is unaware of inflation at this point, but what we have to do to control it. And the things that we have to do to control it are to tighten basically the money supply. And if you just think about the most simple definition of inflation, if there's nothing else you remember of what I say today, remember this. It's more money chasing fewer goods, okay? We did that in earnest. We created more money in the system. We spent a ton of money. We printed money. We threw everything at the problem, all the money we had, and then we had this supply chain issue. So we had more money and fewer goods at the same time while everybody was sitting at home wanting to spend money on stuff, right? So then we come up with this inflation problem, and what we're trying to do now to control it is hurting the market, but rightfully so. And I can get into that more later if you want me to, but anyway, that's sort of how we got here and the problem that we're faced with. The problem is not solved, so it's not over.
Not solved, not over. Right. The Federal Reserve would like interest rates to be in that 2% range. What are we, 8.2%? Pretty large gap there.
Yes.
Right? So that means they're going to stay aggressive.
Right.
But I think what a lot of folks are having trouble putting their heads around that aren't as deep in this as we are is, why do rising interest rates affect like the big tech companies that were running so hot over the past few years? What is it about them that makes them so sensitive? And since they drive so many of the market returns because they're so heavily weighted, they're so big, why does that actually, what's that dynamic?
Yep. Two things. I'm going to try to answer this as quickly and succinctly as I can. So technology today is about 20, depending on the day, 25 to 27% of the S&P 500. That is a huge amount. That's the biggest sector in the index. So whatever happens in tech is what happens in the index for the most part. Back in 1990, tech was 6% of the index. So the world has changed dramatically since then. The reason it affects it, it's not just tech, it's growth stocks in general. So number one, growth stocks generally, you buy them because of their future potential, right? You buy them today because you think that they're going to outperform, grow faster, grow bigger than the other stocks in the index. When you buy something based on its future potential, you have to decide what the price of that potential is today. Part of the math equation that goes into deciding what the price of that potential is today is interest rates. That interest rate number, follow me, I know this is getting intricate, but that interest rate number goes in the denominator of that math equation. That's really all you have to know, okay? As that interest rate gets bigger, which is exactly what's happening right now, that interest rate gets bigger, the quotient, that math equation, spits out a smaller number, okay? So that smaller number is what we will pay today. So there's been this huge re-rating of what people are willing to pay for stocks today because of that denominator getting bigger on interest rates. I hope that makes sense.
No, I hate math, and when you explained that to me before that way, I said, I got it, finally, and then I copy you every time somebody asks me that question. Carolyn, you take a lot of questions from your clients, you take a lot of questions from the public in general. So good with sharing your information, but you have a lot of folks at, near, or deep into retirement looking at this paradigm now, living off that fixed income. Again, 60-40, worst year in history, been a terrible year to be in fixed income. What kinds of questions are you getting from them, and how are you counseling those folks?
Well, the most important thing that any planner should do is people need to understand what their spending needs are. And so we always break clients down into their spending into what are the needs versus the wants. And you always make sure that the needs, the must-haves, are conservatively invested. So you talk about that 60-40 portfolio. For people who are actually living on their money, we actually may have a 50-50 portfolio. So more heavily in bonds, make certain that they have high quality cash that is going to last for a few years when they're actually living on their money. We don't care what the market's doing. Our biggest pain is actually when the market's doing well, because everybody's screaming, oh, my friends are making 30% and I'm only making 15. It's like, well, when your friends lose 30%, you're going to lose a heck of a lot less. So by understanding your spending needs and making your asset allocation conservatively invested in retirement or close to retirement to meet those spending needs when the poop hits the fan, I don't know of a better way to say that, then your clients are sleeping more. So fortunately, it's this time of bad markets. I've been through the .com. I'm old now. I've been through the 2008. So been there, done that. And it's just so important to make certain that the people living on their money are conservatively invested so they can sleep at night. This is actually a golden time for me that clients are saying, I'm so glad we have you.
Yeah, good. And we say, or you say in financial planning circles and in the advisory business, what does it cost to be you? And what does it cost to be the you that you want to be? And once you establish that, then you can set the parameters, right? Set the plan up. Kristin, we did a joint survey, financial literacy survey across the United States last year, and you and I are always blown away by some of these statistics. The expectations for folks in terms of retirement, what they think will provide them with that retirement at different ages, that's a little bit mind-blowing. Take us through some of the highlights, especially millennials and Gen Z.
Yeah, so if you haven't read our financial literacy survey, I definitely think you should go online and check it out because, like I said, some of the insights are actually pretty incredible. I thought I knew my cohort, the millennial cohort. I don't, clearly, as well as I think I do. First, and what I think is most interesting is, and I don't know if the pandemic played a role in this, but there's clearly a big shift happening with especially younger folks and younger investors around retirement. What it looks like, how much it's going to cost, and when it's going to happen. I had thought that millennials figured that we wouldn't be able to retire at all, that we were just going to essentially work till we die because Social Security is set to run out in a little over a decade. Pensions are not a thing for most workers anymore, and they have to rely on themselves. And how many people are out there investing and have no idea what they're doing? You know, they get a 401k at their job and they have no idea what these target date funds are. They have no idea where they're supposed to put their money. And so I thought people figured, hey, I'm not going to really be able to retire. But in the survey, we actually found, no, not only do they think they're going to retire, they think they're going to retire earlier than the actual retirement age, which says that if they are at least attuned to the fact that they know they're not going to be able to pull money out and get Social Security benefits, for example, without some sort of penalty, that they're going to have to start relying on those investment accounts earlier. And I'm talking 57 for Gen Zers. I'm looking at 61 for the millennials, which is a little bit closer, right, to the retirement age, which is in the mid-60s. But they're starting to have these conversations of, do I actually need to just work now and then sit down and when I'm 75 and then I can maybe go travel? I mean, I don't want that, you know? They're thinking about instead of maybe a different hybrid model, and I think their investments are starting to reflect that because they know they need more cash earlier. Carolyn, to your point that some of those investors are looking at their friends saying, hey, I want this with a 30% growth rate. Well, I mean, millennials are instead saying, I want cryptocurrency with an 100% growth rate.
Right.
And they're, of course, to your point, now getting hit by the 100% loss on the other side.
Yeah, and that's the other thing is, too, a lot of these younger generations think crypto and stocks, but crypto was going to help power that retirement. But I also think, to your point as well, the notion of retirement is not the same for folks in those generations as it is maybe for my generation and older generations. Let's get now into the capital markets a little bit, Liz. Obviously, looks like we're doing some discovery here. As we bounce around below 20%, we don't know if the stock market's going to go lower. We know average bear markets actually trade a lot lower than this, and they last for a lot longer period of time. But there's something about the last few years that seems to have compressed timelines. Yeah. Everything is happening so quickly and to the extreme, but it doesn't feel like the resolution of this bear market or what have you is going to be that quick. What's your sense from the way you look at things?
So how do I start this? Timelines have gotten compressed. I think a point that you made earlier of everybody's looking at the financial news. Yes, and I think that's a benefit to many of the younger investors that we have so much more information available to us now. And as an investor, you can educate yourself very easily if you do some searches. The detriment of that is that every piece of information we receive tricks us into thinking that we're supposed to do something about it. And we are not. You are not supposed to do something about every single piece of information that you get on a daily basis, right? Liz Truss resigned today as the UK Prime Minister. the British pound skyrocketed on the news. Should we have all traded on that? Probably not. I mean, I'm not even going to try.
I don't know. How do you buy guilt? I don't even get.
You can't.
Right.
I looked. But so, at least not as a U.S. investor, easily. So it tricks us into thinking that. And actually, not your point about the Gen Zers thinking that they're going to retire at 57, that terrifies me, because it tells me that they think their investment portfolio is going to do what it did from 2020 through the end of 2021. And they've really only lived in an environment as an investor where concentration in a portfolio was rewarded. And what I mean by that is they owned a handful of stocks, or they owned one or two sectors, and it just knocked the cover off the ball. Or they were one of those meme traders that actually did it the good way, right? That is not normal. And a 60-40 portfolio, I would argue, yeah, it died for a while. It's back because it died because bonds were in a period of time when they weren't going to produce a return. Well, now they've seen, as I mentioned before, 3 to 4 times worse year than their last worst year. So they're back at a point where diversification actually can work again. And I think that's really important to remember. Also, as a younger investor, and look, I work at SoFi, most of our investors are younger. More than 60% of our investors are between the ages of 20 and 40. There's rules of thumb. Carolyn, you probably have some ideas about this, but if you take 100 minus your age, that's how much you're supposed to have in stocks. Okay, I'm 40 years old, which is apparently a geriatric millennial. If I did that, that means I have 60% in stocks. I'll tell you what, I have a lot more than that in stocks. But I also have cash. And some of these market dynamics are going to cause you to, or should cause you, to re-examine your beliefs about what your portfolio should look like. And I would argue that some of the stuff that I know Gen Zers and millennials do not like to invest in, things like traditional banks, real estate, industrials, materials, the stuff that they're like, oh, that's so boring, what a snore, right? You have to have it. You got to have it. And you got to have some small cap stuff too, because that is the stuff that leads on the other side of a business cycle. And if we are entering a time where there is going to be a bigger recession, on the other side of it, when it ends, you got to have the stuff that's going to do well, which is the stuff that you probably don't have.
Right, and that goes to the, you could set it and forget it once upon a time when you had zero interest rates, when you had a supportive Fed. You can't do that. You got to look for quality right now. And Carolyn, I know you set up a lot of portfolios with plans in place, and there is a plan for times like this, or even the hot times. But in terms of having enough money, that drawdown money, to be able to live the life that a lot of your clients have been planning to live, do they have to make adjustments? If so, how do you make an adjustment this late in the game? Say you're 65, 70 years old.
So this whole conversation is so interesting to me because I started as an emergency room doctor, right? And so I saw people die way too young, and you never know when you're going to get sick and die. So that comes to your point, and I think the younger generation has this, that I want to make sure I'm living now. And so I think we need to change the definition of retirement. I also do a lot of work in aging issues, as you know, and age 65 was picked in the 1930s when average life expectancy was, guess what, 65. Now average life expectancy is into the 80s. And so you don't want that last 30 years of doing nothing. I think I do this new talk called Are You Happy Now? About are you living the life you want now no matter your age? And the way we're now planning for future and for retirement, which I hate, is making certain that people are maximizing their life now and creating resiliency, saving for the unknown future, for career changes, for when they're going to get a serious illness. And so this is a long answer to your question, but that portfolio needs to be very individualized to the situation that the person has at that moment, whether you're 20, 30, 40, or 50, making certain, one, that you have that emergency fund, and that, so the cash, because you talked about you have cash, because if you lose your job or we have a big upheaval in the markets or a pandemic, you have that cash set aside to weather those things. And then two, what happens if your career goes away? You have money set aside in safe assets so that you can switch careers. And we spend a lot of time actually helping people change careers so they can work longer. And to me, work is not a dirty word. It gives us a sense of purpose. And so helping people do their portfolio in a way that supports them through their life as they make changes and ideally work until they can no longer work. And so, long answer to your question, so how do we, if it's too late, if you're in your 60s, go back to work. Your human capital is your safest asset. We don't have enough people working right now. And so that's your number one portfolio diversifier, is your ability to work. And then number two, look at what the cash needs are. I don't care how bad the market is right now. If you don't have money to live on, you're going to have to take a little haircut to create that cash you need for the next couple of years. But then don't freak out. You know, I've been through a number of bad markets. The reason why people do poorly is because when the market crashes, they sell everything. That's the total wrong approach. And so make sure you create an asset allocation for yourself and stick to it. Right now, if your stocks are down 40% and you're supposed to be 60% stocks, do that painful thing and bring up your stock allocation right now. People are so afraid. They run when they should be going back into the market, and they go to the market when they should be diversifying to safer assets.
Yeah, they say the stock market's the only store where people run out of the store when everything goes on sale.
Right.
Because they're like, I wouldn't put more money into that. Are you kidding me?
Yeah.
But you got to pull it back. And when you pull it back, Liz, 5, 10, 20, 50 years, you see it does go up and to the right with some dips. Not to say that we're going to come out of this anytime soon, but how important is that long-term perspective? And then to the other point you were making, how do you build the foundation now for what's coming? Because ultimately this is a discounting game. What am I going to be paying for future profits, and how am I going to establish my portfolio today to take advantage of those?
So if you look at a very long-term chart of the S&P 500, also quick little lesson, we reference the S&P 500 because it's the most all-encompassing index. A lot of times we hear about the Dow, it gets covered on TV. Don't look at the Dow. The Dow is 30 stocks, that's it. The biggest one in it is a health insurance company. I would argue that health insurance is not a good indicator of the American economy, right? So it's only 30 stocks, it's price weighted, so the higher the price per share, the bigger the weight in the index. It doesn't make any sense. So don't look at that. Look at the S&P. So if you look at a really long-term chart of that, you know that it's upward sloping over that entire period. If you chop it up into smaller chunks, if you chop it up into 10-year periods, there are some 10-year periods that are flat. But, okay, so full disclosure, that could happen. You could have a 10-year period if you time it in an unlucky way where you're flat. If you lengthen it out to a 12-year period, you're never flat over history. Okay, I'm not saying it can't happen, but it has not yet. So time is always on your side as an investor. Carolyn just told us that we have more time, luckily, than we ever did before. Right. So time is really on your side. And because a lot of this is, we talked about women's health before, so there's a lot of women listening to this. We outlive men, so time is really, really on our side, okay? So use it to your advantage. If you are my age, if you're 10 years older than me, you will live through multiple more business cycles, which means you will see more recessions in your future. I'm never allowed to say I guarantee things. I guarantee you at some point we will have another recession. Shortly thereafter, we will have a recovery. That is just how this works. And going into it, you have to manage your emotions to not run for the door, right? Because here's what happens in a recessionary environment in the market. It's like a crowded gymnasium. Suddenly the lights go off, the fire alarm rings, one door opens. Everybody tries to run out at the same time. Guess what happens to the last half that get out? Really low prices, terrible liquidity, not a good situation. So don't run out at the same time, right? Wait it out, because again, time is on your side. And then when it feels the worst, and this is so counterintuitive, when it feels the worst, when fear is at its height, that is usually when it's a good time to go against your sort of fear instinct and say, oh, I should pick up some bargains. Okay, so then what are those bargains? I mentioned this a little bit before. So going into a recession, what are the safe things that you want? Safe sectors, safe asset classes. You want things like dividend-paying stocks, large-cap dividend-paying stocks, because you sort of get paid while you wait. Okay, and cash is more valuable than growth prospects in that scenario. Staples, consumer staples, big dividend payers. Utilities companies, big dividend payers. healthcare, not necessarily big dividend payers, but thought of as defensive sector in the US. And then you look at asset classes, things like cash. Cash is okay to have. Gold, and now in this environment, treasuries, frankly. Those are kind of the traditional defensive pieces. And then when you look at what does well coming out of a recession, where do you want to have exposure? Cyclical sectors, okay, what are those? Those are things that do well when the economy is getting better. Things like financials, industrials. Industrials are, Caterpillar, Deere, Boeing, big machinery companies, building things, manufacturing. You want to have consumer discretionary stocks because people start spending again. You want to have small caps. Small caps lead out of almost every single recession that we have data for. And they end up being sort of that growth engine in the economy. So keeping your wits about you and knowing that you do have to have an allocation to different things at different points in the cycle, but also knowing that you are never going to call the cycle exactly. I am never going to nail the bottom. I will try for the rest of my career. It's never going to happen.
And they ask you on TV like 5 times a week.
They will ask me today at 4 o'clock, and I will be wrong about it. So there's no point. There's no point in trying. But if you get close enough, and we're down 22% already this year, we're getting close, right? Worst bear market that we've had was the global financial crisis, down 55, 56%. I hope that doesn't happen again. During COVID, it was down 34%, okay? So let's say you buy down 25, good enough. Wait it out, right? Because then you get a pretty good bounce on the other side.
Yeah, time in the market better than timing the market always. And another point, I think I heard you say it once or before, is half of the best performing days in the stock market occur during bear markets.
Right.
So if you're out because you're afraid, then you're going to miss some of these 2-3% jumps, and we've seen them in the past few days. Kristin, investing has become more accessible to a lot of people. We have 0 commissions now. We have every online broker out there that wants our business, everybody's business. It's more accessible to people. We know millions of people joined the stock market when the pandemic started. There wasn't a lot to do, and there was money coming in. What have we seen in terms of behavior around those platforms, around trading activity, around enthusiasm, particularly among the folks that read The Balance and that demographic?
Yeah, it's funny based on what Liz is saying. There's conventional wisdom from, the Oracle of Omaha, Warren Buffett, and just so everyone remembers, because money is really emotional, but this is a time when you have to take the emotions out of it and you have to get disciplined. And this is a problem because younger investors are not disciplined at all, this is what we're seeing. So you need to get fearful when others are greedy, and you need to get greedy when others are fearful. So this is a time when everyone is fearful. So this is a time, if you are a younger investor, and when I say younger, I don't mean 25, I mean 35, 45, even in your 50s, this is a time for you to start getting greedy because everyone is starting to get very scared. For when it comes to the younger investors, we are seeing them, they were already over-indexing on crypto. Some of them are actually starting to buy more. We're seeing a lot of very strange, I wouldn't say it's strange, it makes a lot of sense, but strange in the sense that it's not a good idea. I literally last week was talking to a guy, he must have been almost 40, and he told me that he liquidated his entire investment portfolio.
Oh God, my heart hurts.
I know, mine did too. They might have heard me. I was at NBC. They might have heard me gasping loudly off to the side because I was like, why would you ever do that? That was the worst thing that was a terrible mistake. Go back. You have to put all that money back in. You've cut some losses probably, but you need to go put that money back in. But we are seeing investors starting to either pull out of the markets or they're starting to pile in, but they're piling in on some really risky assets.
Oh my gosh.
Cryptocurrency, they're piling in
Crypto,
on.
the options market has become a playground for a lot of day traders.
And think about it, NFTs, when Jack Dorsey's first tweet became an NFT, I think it sold for like 97 million. It was sold for an absurd amount. The bid on it lately was like $12. Don't quote me on the numbers, but this is just to show how much loss has really happened in that market. But this is where folks are really looking for some gains here. I think the thought process is, okay, over the last 2 years, I have absolutely seen everything I honestly throw a dart at has been a winner. And so what I'm going to do now is I'm going to get those things that I think are winners now for cheap, and I hope that I'm going to start to have the same kind of crazy amount of success that I've had. in the past couple of years.
Right, but as Liz points out, the denominator's changed.
Right.
The math has changed, and you have to think about that as you either reposition your portfolio, rebuild your portfolio, or start to build your portfolio. Carolyn, are there strategies people should be taking or could be taking in terms of investment vehicles that make sense at a time like now? Do you want to potentially take losses? Do you want to convert from a particular type of a retirement account because of what's going on the monetary policy front, but also on the financial policy front in terms of some of the rules?
Right. Yeah, I was bursting as you guys were speaking because the key with successful investing is discipline. And one tool that we use as financial advisors is called an investment policy statement. This is something we draw up with a client that says we're going to be this much invested in stocks, small cap, international, all the different asset classes out there, how much is going to be in bonds. We don't do crypto. I mean, so that's probably heresy with the younger crowd, but you could have your small slice of crypto and create so you can do this for yourself, create a contract with yourself saying, I'm going to stay in this asset allocation, and when the market drops, always rebalance back to that allocation. So you're forcing yourself through your own contract to buy low and sell high, because when stocks do great and everything bounces back and now your stocks are a big chunk of your thing, it's like, oh, stocks are doing so well, I don't want to sell that 10% to buy those little things that aren't making much money. Perfect time to do it. So as far as the vehicles, you have professionals that do this day in and day out and do the active trading. I'm a fan, and Warren Buffett said this too, of using low-cost vehicles that are tax efficient, so using ETFs, and making certain you understand the different components of asset location. So you should have a Roth if you're young. That should be where your aggressive stuff goes. Your IRA probably should be holding your bond portion, and your taxable account where you're paying taxes along the way should be invested in very tax-efficient vehicles like exchange-traded funds and municipal bonds if you're in higher tax brackets. So we don't believe in fancy for the regular investor. And Warren Buffett says this too, because you don't have the time, energy, or education to totally research all these things. So just use the easy stuff that's low cost.
Yeah, and to a point Liz made earlier, you don't have to do anything either, right? Professional investors, they have to put money to work. That's their job. We don't have to react to news. We can know what's going on. But remember, we have the plan, and this doesn't change the plan unless it actually does change the plan, and then you got to actually do the work. So let's talk about some trends happening globally. Liz, obviously, it's the entire world except for China and Japan are raising interest rates right now. The UK is going through a very peculiar situation over there. Globalization may be kind of coming undone a little bit or changing. We got older demographics. You know, the country itself is getting older here. Is the U.S. the place to remain invested if you're a U.S. investor? Should we be looking globally as we rebuild, reassemble our portfolios? Where do you concentrate today?
So yes, the geopolitical risk, tension, and uncertainty at an all-time high, I would say. Even today at an all-time high. There's an ongoing war. There's a lot happening. I've continued to say we right now are the best country on a bad planet. That still doesn't feel
Cleanest
great,
dirty shirt.
right? Yeah, no, I'm just my words, right? That was Bill Gross, I think that said that. So I needed to use different words. But when you think about it that way, it's still not a great setup. And all of these ideas about, globalization is dead. And look, this is not a political statement whatsoever, I promise you. Because I fall kind of 50-50 on a bunch of these issues, but I don't think globalization can ever die entirely. There's so much competition for that next buyer that whether you're a country or a company, you do at the end of the day still have to look at economies of scale. You have to look at where does it make the most sense to create your widgets to sell them to the person who's going to buy them. And from a market perspective, it's never going to die either because it's now so accessible for us as U.S. investors to invest abroad. Unfortunately, it hasn't worked over the last decade or so, but at some point it will again, and the timing of things will be different. So what's happened in the last even 5 to 10 years is that you had central banks around the world all moving in the same direction. So it was really difficult to say, okay, this is a better opportunity than that country, or this region is a better opportunity than that region, when they were all sort of doing the same thing, right? And you still had pretty good opportunities here on our soil, and you didn't have to face any of the currency translation. So it did make sense to stay more US biased. As we look ahead, the dollar has been very, very strong this year. I'm sure people have heard a little bit about that, right? We've been at parity, although we're not at parity with the pound anymore after today. But we've been at parity with the euro for a while, which means that it was 1 for 1. And it hasn't been 1 for 1 for a long time. So if you find yourself in Europe, go shopping, because it's working right now for you. That is a new dynamic that hasn't been available before. The dollar being strong is bad for emerging markets. I won't explain the intricacies of why, but it is. So at some point, it'll stop being bad for emerging markets if the dollar weakens, and then emerging markets might actually have a good day in the sun. So there's still opportunities everywhere. The other thing I would say about globalization is we're still very, very worried about inflation today, okay? As we should be, as are most countries around the globe. If globalization ends, that means that we have to do what's called onshore all of the production. Take it out of the other countries, do it in the US. That is expensive. It's expensive to move it here. It requires us building things in order to do that. And then the cost of producing all those goods is higher. So guess what? Onshoring is inflationary, okay? Trade sanctions, all the geopolitical risk that's going on, the trade sanctions that we've put on multiple countries, it all started basically with China. Trade sanctions are inflationary because, again, it limits our ability to search elsewhere for lower cost production and so on and so forth. So that's 2 items of deglobalization that are inflationary. The last thing is, if you limit immigration, we've got a really tight labor market as it is. You limit immigration, that lessens the number of people available to work, okay? If you have the same amount of jobs available and less people to work, wage pressure continues to go up. Also inflationary. So that's a triple whammy of inflationary pressures if deglobalization happens. So I would argue that none of us really want that to be the case.
Right. Most governments are fighting inflation, so they're not looking for ways to light the fire under it. They're looking for ways to make it easier. And if you don't feel like it's still globalized, even though we don't import that much oil from Russia or Ukraine, when you get 10, 11% compromise in the market, look what happened to gas prices. Look what happened to oil prices. All right, I want your hot takes for next year, not your investment advice, but your hot takes. What do you think that we're not talking about that we need to talk about more as we head into the end of this year and into 2023? Let's go down the line.
Ooh, well, we talk about it on my side of the table, but I'm guessing you guys don't. I would say some of the consumer credit risk that's out there and just credit risk in general. Historically, the bond market knew stuff before the stock market knew stuff. That is no longer the case. And the bond market, from a credit perspective, the things that we look at, has not blown up yet. Doesn't mean it has to, but it just doesn't really make sense where it's at. I think that there's probably a few more cracks that will get wider, and that is likely in some of the consumer credit stuff and in the high yield bond space.
Yeah, and on the household credit side, you're also seeing rising credit card balances, rising debt.
Credit cards.
We see APRs going up and up, and people spending more on their credit cards. Carolyn, hot take.
Well, so I'm very biased because I work in both the health world and finance world, and I have a fear that our medical system is very, very broken still, and we have many, many issues that can occur, not just with pandemics, but with other health events that could really disrupt our economy. And I feel that, everybody talked about the Affordable Care Act giving people insurance, but it didn't actually give people health care. And so our broken healthcare system and the cost of our healthcare system, you talk about the insurer being the top of the Dow, that's wrong. It's just another symptom of our broken healthcare system, that we're going to see an implosion of our healthcare system that's going to cause us a significant havoc in this country. I sound like such a...
Good thing you're on the next panel, because we're going to have to get into that a little bit more. That's a hot take.
Yeah.
because I love politics, I'll just look at that. So we're in midterm season right now, but we're going to be heading into a general in 2024. And there's some interesting economic, or at least policies with huge economic implications that you already hear discussing right now. A lot of states are considering tax cuts. Again, as we start to see Republicans and Democrats really start to go out and try to snatch votes, I have a feeling and a suspicion we might start to see more of that really pop up. And then just because I loved this stunt, I'm going to mention climate change. We had Hurricane Ian, but these climactic events are obviously huge, and they're huge. It's not just our world is going to explode one day issue, but it's also a huge strain on economic systems globally, and I have a feeling we're going to keep talking about that more and more and more.
Yeah, climate, migration, more poverty, important hot take, and I don't think you're wrong on that. We're going to take some questions, and then we're going to take a little bit of break. So we have anything online first or in the audience, and then we'll...
We do have a few questions online. First one is, where should real estate fit in with your investments right now versus securities?
I'll let you start there, Liz.
So you can invest in real estate directly by owning actual property, or you can invest in things like REITs, which are real estate investment trusts. You can do it in like an ETF format, so that's sort of a security that you can own in your portfolio representing real estate. Or you can do what I would call real estate adjacent and buy things like home builders or stocks like Home Depot or Lowe's, that sort of thing. So those are just the ways that you can approach it. How should it fit in? So real estate actually is now its own sector in the S&P. That is new in the last 10 years. And you should treat it as such. Treat it as its own sector. And what I mean by that is it's no longer just this kind of ancillary little blip on the radar. It's a real investment, and it's something that you have access to as a retail investor. Lots of times we lump real estate into what's called the hard assets category. And during inflationary times, hard assets tend to ride that wave up. And then when inflation falls, they ride that wave back down. I would still expect some of that to go on in the actual prices of real estate, so in home prices themselves. So I guess I would say buying a house right now, probably not a great idea if you can avoid it, but you can start to look at things that would lead, things like home builders, like I already talked about. Those tended to break earlier. They already broke. They've had a really bad year, down I think 40% something this year. And you can buy an actual home builder ETF, right? So looking at things like that is kind of a way to get ahead of it. But do not abandon real estate as an asset class. I think it's an important piece of a portfolio.
Yeah, then there are the companies that own a lot of real estate that you don't even think of. The Blackstone's one of the largest warehouse owners in the world. Lots of ways to attack it. Let's get some from the crowd here, and we'll go back online. Doctor?
Thank you. Thank you for that insightful conversation there. It was very great advice and tips there. I actually have two questions. One is, Carolyn, just like you had mentioned, I've seen a couple of, dating myself, I've seen a couple of cycles of recession times that we've been through, and I can even recall remembering back to my father complaining about the Reagan era and the inflation rates at that time that we're going through similarly now. So my first question is, a lot of the investment advice that I've heard over the years tends to be very consistent over time. The rules have stayed the same for the most part, the assumptions have stayed the same, but the world has drastically changed over the past 2 decades, right? I mean, we don't work the same way we used to work in an industrialized economy. We're a knowledge economy. A lot of gig workers, the 401k, when people are hopping from company to company, has completely changed the game. The retirement age, as you brought up, is completely shifting underneath our feet. The globalization of the world. So I'm just curious, what are some of the new assumptions or new investment rules that we should be thinking about in today's climate, given some of the market and environmental changes that we've seen? That's question number one. Question number two, if I can throw out there and you can answer it at the same time, the American dream used to be saving up enough money to buy a home. I'm curious what your thoughts are and what the new American dream should be.
Want to start, Carolyn, and we'll go down the line?
Say not it.
Yeah, gosh.
I definitely have thoughts on the second one.
Yes, that is loaded. To me, the number one, the true American dream should be a life filled with love and joy and a sense of security. And part of that is having a safe place to live and having health care that you know you can count on. So it's a very different definition of the American dream. Now, as far as rules around investing, because it has changed, this is where I think we need to wipe out this whole assumption about retirement and living for the future. We should plan, just like my new talk is, plan to be happy now and learn how to plan for resiliency. I don't know how much of you have ever read Nassim Taleb's work. I'm a big student of complex adaptive system science. And what that means is we don't know what we don't know. And it's going to bite us just like everything has now. The pandemic. Actually, I tweeted in 2013 that coronavirus is going to cause the next pandemic. I knew it. A lot of us that worked in public health knew it was going to be an issue. I just didn't know when. And so we don't know what we don't know. And so we need to change our investment styles and our expectations for the future around planning for resiliency instead of an unpredictable future.
Kristin, you want to take the one on the dream?
I think it's two things for the American dream. It's freedom and it's time. I think that people don't care anymore about buying the house. I don't think they care anymore about the white picket fence, working till 65. I think it's freedom of movement and their time back. And I think that changes actually how they're starting to invest. We're starting to see the rise of things like people, best friends buying homes together, co-ownership with not just, and it used to be, right, you only co-own with a partner, your spouse. Now co-ownership is happening between friends, business partners. People would rather actually not even own a home. They'd rather rent. It's too expensive. They're throwing away when they think about they need to have children. All of these rules are changing, and I think it's all centered around their desire for freedom and time.
It's a great point. Up top?
Hi, good afternoon. I'm also a geriatric millennial. I won't tell
Welcome.
You that. Yeah. But I also have an almost 19-year-old. So I have two questions. I was one of those who made a ton of money buying and selling Zoom during the pandemic. So in terms of like cash, where do you keep the cash? Because I didn't really believe in having this cash thing. Where do you keep the cash? And secondly, I have an almost 19-year-old who lives in Europe now, who is doing professional sports, so he thinks he's cute and hot. So I need to know, yeah, that's true, he does think that. So I need to know how to gently guide him to make sure that he doesn't go broke.
Okay. I might let you take the go broke one, so I'm assuming your question about where do you keep your cash, you're not asking me like, do I tape it to the back of the toilet or shove it under the mattress? It's like, what do I put it in? How do you keep it liquid, right? So I'm just gonna answer this from a personal perspective. It's in a couple different places. I have, a regular bank account like anybody does, and I have a savings account in that I keep like the emergency funds in, right? That I can literally go to an ATM and take that out, and if I need a $100 bill today, that's where it is. And then I have my investment accounts, and in the investment accounts, so cash defined as an investor is really anything shorter than 90 days, okay? So you could buy T-bills, which are treasury bills, and as long as they have a maturity shorter than 90 days, that counts as cash, frankly. And right now, interest rates are decently high. You can actually make money on that. That was not the case, and that's something that's new. So we talk about the rules changing. You can make money in cash. I mean, that hasn't happened in many, many, many years. And as geriatric millennials, inflation hasn't been this high since when we were born. So we've actually never seen this before, right? So you can make money in cash instruments. There are such things as cash instruments. But you also want to keep some of that cash just sitting in your investment account, because if and when a day comes where you feel like, oh my gosh, I'm scared, what I talked about before, oh my gosh, I'm really scared. I remember this happening on March 16th in the pandemic and March 23rd. The market was down terribly. There were circuit breakers that were going off 4 times that month. I was actually at the New York Stock Exchange one of the days that the circuit breakers hit and the entire stock exchange closed. That was an eerie feeling, but that was an indicator of like, ooh, this is peak fear. I'm uncomfortable, I'm scared, I don't want to buy, which means I should buy. But in order to buy, the cash has to be in my investment account waiting for me to use it, right? So you have to leave some of it there too, and that's what we would call dry powder.
From an individual perspective, holding cash to me is having it in a high yield money market. If you have cash that you're not going to need in the next year, a great place to put that right now is I bonds. You have a maximum of $10,000 you can buy per person. Make sure you name a beneficiary on your I bonds, though. That's another discussion. As far as the professional athlete, young professional athletes, any young person making a ton of money, the key is define your lifestyle and what you would need to have a happy life. I have a professional athlete as a client, young guy, and he keeps a very simple life. And that first few million he made, we called it his safety net, his nut. And that probably isn't a great term, but it's but that is conservatively invested. So even though he's in his early 20s, it's in a conservative portfolio. And all of the money he's making past that, as long as his career is healthy, doing well, he does what he wants with it. And he does not plan, and he is married. He and his wife have a very good head on their shoulders about what is the lifestyle that we need, that if everything went away, we'd be happy. And then that's where we keep that safety net.
Good question. I like to keep it in the Maxwell House tin, just like I did when I was a busboy at 15 years old. I know there are some questions online that we missed, but I want to keep us on time. So we're going to take a break here, a little coffee and refreshment and water break. Stay hydrated. This is a Your Money, Your Health conference. But Carolyn McClanahan, Liz Young, Kristin Myers, thank you so much. Great discussion.